Hello everyone and welcome to this morning's webinar. Oh dear, we are a few minutes late, so I do apologise. As always, before we start, may I draw your attention to the disclaimer that I know you can see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. And I'm just going to whiz through a couple more slides because I know we've got quite a few new people in the webinar joining us this morning. So very quickly, here am I. Here is my husband David, and we will be running this session in tandem, and we will be looking at the live markets through the prism of volume price analysis, accompanied, supported by our quantum trading tools. Volume price analysis, again, I can see from the people in the webinar, I know there are some of you who already bought the books that are on Amazon that explain the methodology and basically what it can do for you as a trader. But in case you haven't, and you haven't come across it before, it's all explained in, there are a number of books on Amazon. The ones specifically for forex, we've actually bundled together in what we call the complete forex trading library. And the VPA, volume price, is the technical analysis side of it's the chart reading. It's using price action and volume to really anticipate, to tell us where the price is likely to be going next, which is of course hugely important. But part of being a forex trader is not, in our humble opinion, is not just being an expert in some form of technical analysis. Although I have to say there are traders who just use technical analysis and don't use the fundamentals and don't look at anything else other than the price action that they see on the chart, because their rationale is that everything has been accounted for in that price action. In our humble opinion, we think that is a very, I should say, not blinkered view, but it's a very one-dimensional view. We actually say, yes, by all means, you have to become proficient at chart reading and using VPA. And what we're going to discuss, we're going to be talking about in this webinar and actually carrying it forward in subsequent webinars, is being able to identify the structure of the chart. What is the market condition? Because a chart, yes, it represents all the the price action on that particular instrument, but the chart is much more than that. It doesn't operate in a vacuum. It is driven by other factors, and those other factors include what the fundamental news is and what is happening in related markets, particularly in the forex market, where currencies and currency pairs are actually proxies for either risk sentiment or for other markets. A classic example is the oil market with the Canadian dollar, the Norwegian krona, because these economies are hugely dependent on, they're big exporters of oil. And we've actually put it together and we've called it the 3D approach to trading. It actually also applies to investing. I have to say, since the books came out a few years ago, I think to that we have to add a fourth dimension, and that is the political dimension, which is really, well, there's Brexit and there's China and the US, etc., etc. But anyway, everything is explained in the books on Amazon. And the library is a digital library, and I think it's $9.99, David? $9.99. $9.99. That's all you have to say. This is actually a slide from our education program. I know we are also being joined by some of our students who have taken the program. Again, you are most welcome, and it's good to have you join us, and hopefully maybe you can put some comments in the chat box to explain to other people how you have found the program. This is the slide, if you like, that really sort of sums up what we mean by the relational analysis element of our approach, in the sense that we look at the four capital markets. We've got bonds, equities, commodities, and forex. And forex really sits at the heart of all the markets. It pulls all these markets together. It's where you get the fastest reaction. So, for example, the other day when we, this thing with Brexit going on, we had this big vote in Parliament. What reacted? Well, it was the British pound. I think at the time, one of the votes, the UK equity markets were closed. Maybe the futures market. I think the FTSE futures would have been open. But really, everybody refers to the forex market, the exchange rate, what is happening to the pound, is it being bought, is it being sold, because the selling and buying of a particular currency and currency pair also reflects, if you like, the opinion, outside opinion of that particular currency and that particular economy. Anyway, all explained in the program. And as I said earlier, we have developed, David and I, as well as a volume price analysis. I have to say the volume price analysis, the concepts that are part of our approach, the methodology, that's not new, using price action and volume, but we have, I believe we have taken it steps further. We've included other elements in VPA that you won't find elsewhere, for example, candlesticks, support and resistance, and the principle of understanding the principles of time. Supporting all this for Forex, we've developed some very particular indicators. They're part of what we call the currency dashboard, but they're also available individually. It's where we always start for a view of what has been happening in this market. This is a 24-hour market divided into 3 separate, very distinct trading sessions. We've just come out of Asia, we've started into Europe, and now we're waiting for London to open. London is a massive part of this market. Whatever happened in Asia is awfully interesting. The traders will look back and say, yeah, okay, that's what they did. Did they buy the pound? Did they sell the pound? Did they buy the yen? Did they sell the yen? Yeah, we'll take that on board, but this is what we're going to do. And also we have the local fundamental news that is going to impact the price action. So what these indicators do, particularly this first one, the currency strength indicator, which is really, it is a strength indicator and tells us whether a currency is strong in the sense that it's being bought, or is it weak because it's being sold. But it's actually more than that. It's a flow indicator. It's telling us, you know, where is the money flowing to? Because markets, at the end of the day, are all about money flow. Money is looking for either a return or it's looking for a safe haven, because, you know, times are investors and traders are nervous. And we've added to the currency strength, we've got a matrix which ranks the pairs, which pairs have been most heavily bought and sold. We have an array indicator which tells us the strength of move, the momentum that's in that pair. And finally, we have a heat map which looks at the performance of the currencies across multiple time frames. Don't have to buy the currency dashboard as a dashboard. They all you can buy them individually, you can buy them as a bundle, or you can buy them as a full package. Or you get 24/7 support for life, 7-day money back guarantee, and at the moment the indicators are available at MT45, NinjaTrader, TradingView, and we are working on TradeStation. We are really excited about TradeStation because TradeStation as a platform is immensely powerful, and what it's allowed us to do is we don't just port our indicators over and make them, you know, identical to where on other platforms. We actually look at the platform and think, do you know what, how can we improve it, and also come up with variants of the same indicator, and also develop new ones. And TradeStation is one of these platforms, as I said, is hugely powerful. So we're very excited about that. The website where you can really find out all about the indicators is at quantumtrading.com. So I leave it to you to hop over there, look at the videos, read the support pages, and all the pricing is there as well. The program is quantumtradingeducation.com. It includes the full package of trading indicators, and you select the platform that you want to use. And this is a breakdown of the modules that you will find as part of the program. Psychology is actually the most important one, fundamental, relational, technical, and what we call the mechanics of trading, basically what you have to do to trade. My own site, annacooling.com, is where you will find my latest analysis, thoughts about what's happening in the markets, Forex, and other markets as well, and also details on the books, etc., etc. David, is there anything you want to add to that? Have I missed anything?
Apologies, I couldn't find my chat box, so sorry about that. I was just hunting around for it. Very warm welcome to you, wherever you are in the world. I hope it's a little bit warm as it is here. It's pretty cold and damp as we're moving into the winter here, so I hope it's nice where you are. If you have any questions, please just drop them in the chat box. Happy to answer them there for you. If they're short questions, if they're longer ones, we will answer them on air for you. And just to pick up on what Anna was saying about TradeStation, it is hugely powerful and the flexibility is quite extraordinary. So we have got quite a lot of work to do, and we are also looking, as Anna said, at other indicators, and particularly just picking up on what Anna was saying about flow and sentiment, because that's really all these markets come down to. Whether you're dedicated to forex or whether you move into other markets once you understand the forex market, which actually is the most complex of all four, and sits at the heart of everything else. So if you start with forex and you understand the forex world and sentiment and flow, then you will understand the other markets also by default, if you will. And therefore, one of the things we are looking at very closely as far as TradeStation is concerned is really other flow sentiment indicators which will help you to understand the risk on appetite, risk off appetite, and that will obviously directly link into the related market aspects of how forex sits in the center of this financial world. So there's a lot going on. We're very excited. It takes a huge amount of effort, so please be patient. We do post things up on Quantum Labs. That's labs.quantumtrading.com. So you'll find posts from us there from time to time on how we're getting on. And we hope to have this all done and dusted in the next sort of 2 to 3 months, I would say. So probably after Christmas, early part of Q1 next year. I'm going to pass back to Anna and we will get going. There's a lot of sideways price action at the moment, but we'll see what we can dig out. Anna's on pound Aussie. As always, a degree of volatility as we move into London session. And a lot of traders get trapped into weak positions. They fail to understand that at session crossovers, one of the key areas of price action when we move from one session to another, that is where the market makers step in. It's just a simple way for them to make a ton of money very quickly, because most traders are totally unaware of what's happening in terms of a crossover. Just going to pass over to Anna.
It is actually a hugely busy day today. Very, very quickly, let's have a look what's coming up. There's nothing on the horizon, well, on our horizon. It's the beginning at 8:15 here, where we've got the PMI data, the Eurozone PMI data. But actually, today is it's also a very important day for Mario Draghi, because it's his last ECB. I found this really nice summary over on CNBC, which I put on my Twitter feed. It's actually the busiest day for earnings. And again, this is this related market thing we were talking about. You say, well, I'm a forex trader. Why do I want to know if it's a busy day for earnings? Because the indices are, you know, what's happening in the US market and in the indices and the stock market will have an impact, can have an impact on what the dollar may or may not be doing. So today is a very intense day for, as I said, 45 of the S&P 500 companies, some really big names today. Amazon, Microsoft, Alphabet is obviously Google. And again, it's all about sentiment. So if sentiment sours because these big companies, you know, the things are really shockingly bad, how is that going to be reflected in the forex market? Well, for a start, you're going to see an immediate reaction in the Japanese yen. The Japanese yen will suddenly be bought. The Japanese yen is one of these currencies. After the dollar, it's the most important currency, in as much that it can be both perceived as a safe haven currency and a risk on currency. So it's sold when you know, market mood is happy, it's willing to take on more risk appetite, and it is bought when that mood switches. So that's why we keep an eye on what is happening in the broader markets. Farewell Mario. Yes, it's his last ECB. Last month, if you were trading the euro, you know there were some huge moves on what he on the press conference. That what subsequently came out was that there'd been a little bit of conflict, if you like, among the members of the ECB about what he said, and it wasn't sort of what had been agreed. But I think actually, as I said, I think he was just demob happy. He could say what he likes. Today's his last ECB. Lord knows what he's going to say. I expect he just wants to cement his legacy at the time that he's been at the bank. He's been there for 8 years. His most famous comment was, of course, we'll do everything to save the euro, and he probably did. This is really hugely important. This is actually this speech by Vice President Pence was actually postponed from June. And someone on Twitter actually highlighted it for me, and I thought, and it actually happens during our second webinar this afternoon, where we start at 3:15 London, our local time, and I think his speech starts at 3. It was postponed from June, and he's quite hawkish on China, allegedly. So what he says about, and it's specifically about China-US relations, so you can see, given what's been happening with the tariff talks, how this is going to be, how this is likely to affect the markets in general, and of course, as I said, on the forex market. So it's one, and it's not on the calendar, which I found really, really, unless it suddenly popped into Forex Factory, it's certainly not on Forex Factory, and it isn't even on the investing.com, but it will probably be highlighted on the one that your broker delivers to you. So as I said, a really packed day. It's not been as busy a day at the beginning part of the week. We've had Brexit, of course, but there's always Brexit. But in terms of, as I said, politics, fundamentals, more politics, it's really going to be quite a lively day from a trading perspective. Now, that brings me exactly to, as I said, these topics. As a trader, one of the things you have to try and recognize is, first of all, the sentiment. Where is, how is the sentiment? Is it shifting? Which way is the wind blowing? Is it risk on? Is it risk off? And and anything in between, because it's not black and white. It's not either risk on or risk off. There are sort of shades of grey in there as well. So that's the first thing you have to try and get to grips with as any trader, not just for forex. Then we have to look, how is that reflected in the chart itself? And by that I mean, what are we looking at a chart? What is the structure of the chart? Is the chart in a trend? Is it in a consolidation phase? It's understanding chart structure will actually also, to some extent, determine the kind of tactics that you can, the best tactics that you can deploy on that chart to take some points and to make some money. And this is where we cover this in huge detail in the program. And what it comes down to is, you as a trader, if you like, say, trading reversals, in other words, you like a move to have completed out of congestion, out of an accumulation phase, out of a distribution phase, and you wait for a reversal. You say, right, I've missed that move, and the reason I've got the pound Aussie up is because it's a perfect example of this. And we look at the CSI. Let's start from the CSI. The time frames I use for intraday, for shorter term trading, is I like to look at the hourly chart. The hourly chart gives me a very quick overview of what has been happening to the individual currencies and what has happened, what is happening now, and perhaps what is likely to happen in the upcoming session. But I'm always conscious of the fact that I have to also know when the crossover periods are due to happen. Now, I don't think the person is in the room at the moment. One of our users, what he does, because the timestamp on the MT4, MT5 platform is 2 hours ahead of my local time. So what he actually does, he actually puts vertical lines down to kind of make him aware that we are approaching one of these key crossover points. And what is the CSI telling us? Immediately, the thing that jumps out is, well, this is the British pound. It's actually been bought in the Asia session, and we've got the Australian dollar, which is being sold. Now, the next step is to go and see, well, what is it being bought against most strongly? What is the Aussie being sold against most strongly? And the condition of that chart, so we know this pair, this currency, the pound, and this currency, Aussie, that's what the indicator is telling us. Then we move to the actual pairs themselves. Now, what I've actually done with the matrix is here, is this actually ranks, if you like, these two currencies from the perspective of their counterparts. So if we highlight the pound here, we look at the pound, and in fact, the pound, if we look at the pound New Zealand, that is moving, or has moved, perhaps slightly more than the pound Aussie. This number here tells us that. If we go back to the CSI, the New Zealand is the white line. That's also moving down, but it looks like it may be sort of flatlining a little bit. So maybe that move that we have been seeing in the pound New Zealand, maybe that's kind of coming to not a pause point, but possibly it's sort of run away with itself overnight. New Zealand and Aussie can follow each other. They're both commodity dollars, commodity currencies, so they can move in tandem. So the sell of this Aussie, as I said, is being sold against the British pound. If I then flick the matrix to the Aussie and highlight that, well, what's it mean? Well, we've got the Aussie yen, we've got the Aussie dollar, but it's not really at the bottom. If we look at the bottom here and highlight the New Zealand, in fact, of the two commodities, if you like, there has been stronger selling in the New Zealand other than not in the Australian pound, in the Australian dollar. But so this is what the matrix tells us. I actually selected the pound Aussie for a number of reasons, and one of the reasons is I wanted to explain a little bit about what we mean by chart structure. This is the hourly chart of the pound Aussie, which looks absolutely horrible because the pound has been very, very volatile. This is the other day when, as I said, we had the votes in Parliament to do with Brexit. Now, very, very broadly, if I just shrink that down a little bit, what we have to look at, and it's a perfect example of this, is this pair is now in, I'm sorry it's so scrunched, but it's the only way I could show, is actually broken out into some kind of trend. But prior to that, it has really been in a congestion phase, quite a wide congestion phase, and at times extremely volatile congestion phase, and we can see here. And this is what I meant by understanding the structure, the condition of the chart, because it will determine what kind of tactics, what are the best tactics to use when you are faced with a chart that looks like this. Forget this little trend that has started now, but if we go back here, and yes, we've got this volatility, is broad. Now within the congestion phase, this is the hourly chart, you are going to get maybe micro trends. And if you are a trader that trades on the faster time frames, yes, there will be trading opportunities within this consolidation phase. What you also have here is you have a very volatile congestion phase because it's got the pound in it, and also because you've got candles with very, very big wicks to the top and the bottom. Possible to trade, but you have volatility. What does that imply in terms of risk? Well, your trades are going to be likely to be riskier. The risk of the trade is likely to be risky because when you have big wicks to candles to top and bottom, there's a lot of whips or price action, the chances are you're going to be stopped out more often, and then you have to take the decision, well, maybe my stop has to be wider. But does that then come into conflict with what your money management is? So understanding as I said, the condition of the chart, what are you faced with when you look at the chart of the pair that you would like to trade? And in this case, as I said, these are all decisions that you have to make. As David and I as traders, we look at the 28 pairs, and we will pick whatever pair we think is going to deliver a nice move. You as a trader, you may not want to look at the 28 pairs well, there's hundreds of pairs in forex, but generally speaking, traders stick to the 28 pairs derived from the G8 currencies. They will, a combination of the majors and some of the more liquid cross pairs. There are traders who trade the Turkish lira, for example, but in general, no, because the spreads are going to be very wide, and it's going to be, it's very, very volatile, and it may cost you more. So let's stick to 28 pairs. 28 pairs may not be in your remit, so you're going to focus down. You may going to take 2, 3, or 4 pairs, but one of the decisions you're going to have to make, that if you concentrate on a restricted number of pairs, is, are they in a condition, are they in a state the time that you come to your computer, they are tradable. What are you faced with? Are you faced with congestion, or are you faced with a pair that is already in a trend? In which case, you know, are you going to wait for the trend to reverse on a slower time frame chart, or are you going to maybe look for a micro trend on a reversal on a faster time frame? These are all decisions you have to make. But if you don't understand what the chart is, how the chart is structured in the first place, I believe, David believes, you are going to struggle. Now, to get back to my Aussie pound Aussie here, as I said, the hourly chart gives me an overview, and also what the CSI is telling me. In fact, we've had a huge uprush by the buying of the pound. There's a lot of volatility, and the pound buying has continued higher. So what I use is a Renko chart, which is a non-time based chart. I use the 3-minute chart, and I use a 12-minute chart. And as I said, my hourly chart is my benchmark. Now, having established from the hourly that in fact we're in a trend, it's a volatile trend. How do we know it's a volatile trend? I know we haven't had the volatility trigger indicator trigger, but we have, look at the wicks either side. What we also have with the candles, look at this candle. Let's have a look at this candle here, where we have 87.80 and we have 88.25. In that hourly candle, there was a big move. There were a lot of pips in that hourly candle. So on the faster time frames, there would have been there's enough volatility in that candle, volatility in the sense of range in that candle, for there to have been an opportunity to take some trades in the faster time frames. Not all of them are as wide ranging. Look at this one. This is very narrow on the day. We don't know how we're going to, what's going to happen in the session ahead, but all I can tell you, that is a trend, but it is a trend with volatility. It is tradable, but you have to recognize it, and you have to use the right kind of approach, the right kind of tactics, the right kind of charting, the right kind of indicators to be able to stand a chance to actually take the points that are available on this chart. And before I pass over to David, in contrast to that, and we'll talk about it later, I want to look at the Aussie yen, which I actually wrote about on my Facebook page, which is Learn Forex Trading. It's over at Facebook, to explain why, a 30 pip move in the Aussie yen, was it yesterday, took how many hours, David? Was it 15 hours? And you say, well, why did it take so long? There was a technical, the chart looks amazing. Oh, what a fantastic trend! But you actually, look at the number of pips that it delivered over that period of time. It was a grind. It doesn't even begin to describe it. But there were fundamental reasons. There were reasons why that particular pair did not move. There was no expansion in the move in the individual candles. As I said, we'll talk about it later, or you can read about it on Facebook. David, have you been following the pound Aussie, or have you been following another pair? Let me have a look, just see what the CSI says. David's got his eye on all sorts of things. But so the pound Aussie, right, so what do we do here? This is the move, this is the Renko. This is smooths out all that whipsaw action. And in terms of how you use the Renko, the way I use it is I like to see a change in trend in the trend dot, which is very close to the price action, to bright blue, matched with a change in the blue in the trend monitor. We can see here the little pullbacks, the trend dots go grey. We have pivots here. Pivots help to define areas of congestion, and in fact a Renko chart, because you don't have the wicks to the candles, is a great way to explain what I mean by the state of the chart. I mean, this is the trend higher, but you can see the number of pullbacks, very, very volatile in this move higher. Then we had this reversal lower, and as I said, this is the trend that I've been following high. But look at the number of times we had these pullbacks. Look at the number of times it came back. And in fact, it did actually go to a red trend dot, but the trend monitor never moved. Now, yes, we have volatility on the 3-minute chart, as we see here, huge candle, Not a lot of volume under that candle, but a big move for pound. What happens? We've had a retrace to within the spread of the candle, a lot of volume under, and that this is where you still use the VP, the concepts of VPA. Are we going to get a reversal out of here? Well, in terms of entry, as I said, because I use the Renko, and of course I'd be looking at what the CSI is saying as well. We would have to wait and see. If you were long and that volatility hits you, you say, well, actually, depending where you got in here, you say, well, you know, I may just wait for this to play out, because on the hourly chart, going back to the hourly chart, yes, we've had this retraced within this spread of this candle, but look at this support and resistance. Look at the top resistance line here, 89.27. It's been hit, almost hit there. 1, 2, 3, 4. Is it any surprise? It's hit it again the 5th time. Is it any surprise it's actually come to? And it's just coincided with the London Open. Move over to
Just switching screens onto NinjaTrader. That was Anna on MT5. This is NinjaTrader. Should be coming up. You can see it's over there now, which is great. This is on the 5-minute CSI, and it really does highlight what I was saying earlier about what goes on in terms of the crossover session. The nice thing with NinjaTrader is you actually see the correct times. This is our local time here, so it prints the correct time. So you don't have to hunt around. You don't have to put lines on. This is in real time, so you can see where 8 o'clock is. This is the London Open, and you can see what happens. We get these spikes, these reversals, and it's just a classic example this morning of what goes on at the crossover and the trap moves. I'm just going to head on over to the charts. That's on the CSI. You can see the sharp move up in the pound. We've got the dollar falling, the yen selling off sharply, as is the Canadian dollar. We've got the Aussie dollar down here flatlining, very oversold, looking possibly to move higher, and the yen diving really strongly. Hop over onto the charts, multiple time frames. This is on euro pound, and it really does exemplify the traps that go on at the London Open. If we pull up this one on 5, just a really nice example, the volatility has been triggered. You can imagine traders, sorry, excuse me, I just moved the chat box out of the way. You can imagine traders jumping into this, sell the pounds, all bad news for the pound at the moment. There's no Brexit deal, Parliament's in a mess, and you know, there's no way forward. Europe doesn't know what it's going to do. Is there going to be an extension? Is there not? Is there going to be an election? Blah, blah, blah. And what do the market makers do? Crash, down it goes. But look at the volume under it. This is the London Open, remember. The volume here should be much, much higher. It isn't. It's relatively low. So this is a classic trap move. The volatility indicator gives you that heads up anyway. You're always expecting a reversal, whatever, or at least a congestion at any rate. It's either going to congest or reverse, one or the other, because that is the mechanism that the market makers use. Volatility is nothing more than a compression of time. That's all it is, because this price move, which is whatever it is from 86.20 down to 86, let's say it's 20 pips odd, under normal market conditions, that might take 20 minutes, whatever, 30 minutes, whatever it might be. And all that's happened is the market makers compress time, and that price action is then occurring in a very short space of time. This is a 5-minute chart. The reason they do that is very, very simple, because traders, one of the big fears that many traders have, in fact we all have, is a fear of missing out. We want to make money quickly. And as Anna highlighted on the Aussie yen, if you're sitting there grinding out 20 or 30 pips over a 15-hour period, that's hard work. What we're always looking for is a fast move. We want to make money quickly. We want to jump in, make our money and get out again, which is why volatility is so powerful. Because what it does is it draws you in. It draws you in emotionally to something that is moving very rapidly. It's very primeval. It's, if you like, looking for a kill. You see something moving quickly. You want to eat, and you take aim and you fire before you even think about it. That's what this is like. It's the primeval emotion of not missing out on a trade. So you see something fast moving, you think, oh, I don't want to miss this trade. You jump in, and then you get trapped. It's so simple, so powerful. And this is one of the opportunities that the market makers use every single day of the week, particularly at the London Open. This is a trap move because the volume's not great. It's as simple as that. More importantly, you're seeing it across all the various time frames. I've got a very fast chart up here. This is 15 second, which if you're learning VPA is a great way to start, because I'm not saying go down to 15 second, but maybe perhaps a minute if you're on MT4, MT5. Pull up a fast chart and start reading it in real time, because it's the quickest way to get alongside VPA and all the signals, all the anomalies, understanding the anomalies of not only single candle price action with volume, but also in terms of groups of price action and everything else. But what we're seeing here, we've got it on 5. We've already looked at that chart. This is a 10-minute, pretty much the same, just confirming. Volumes, it's way too low for that. Now we're seeing a ton of volume coming in as the market makers trap everyone into weak position. Exactly the same on 15. There we go. Huge volume under this one, relatively light volume under that one. We've got volatility trigger on this one building as well, which is another aspect to the indicator. It will arrive before the candle has closed. So you know for a fact that there is volatility. We've moved outside the average true range. The volatility works on average true range, and all average true range is really, as the name sounds, it's looking at what is the expected price action. These are typical. This is what you expect to see typically on a 5-minute chart for this particular pair, not huge ranges. And as soon as you move out something which is considered the norm, which is what average true range is about, that's what triggers the indicator. So it's very simple, but immensely powerful. And as I've said many times before, if I'm in a position and volatility is triggered, invariably, if I've got profit in the position, I'll close it out, sit on my hands and wait for the next move to come along. This is on 60. We haven't got volatility there, but certainly up into 15, we can see what's going on precisely and where we're going with that. If I just put cable in as well, let's just switch that over onto cable, see where we are. Similar picture there. Obviously, the reverse, we've got the move to the upside here. Again, you can see relatively light volume. This is 8 o'clock, so we've got a volatility trap. Up we go. Long-legged doji candle. I've said many times before, long-legged doji candles are not about reversals. They are about indecision. So it's a classic example there of just indecision. The market's not going to go anywhere. We know that for a fact anyway, because we've got volatility, and now we're starting to see the market reverse again and come back off that move. Lots of traders in there now, trapped, wishing they hadn't jumped in, perhaps waiting. Being patient is one of the hardest things to do. Just going back to what Anna was saying about chart structure, I'll just leave that running for a moment. The way we describe it in the program is in terms of C states, because it's the only analogy that we could come up with which actually worked. And in terms of those C states, it's really, if you think of it in terms of stormy seas, calm seas, have we got, in other words, volatility? Have we got a volatility with trend? Are we volatility with congestion? Are we in the doldrums? Are we moving sideways with very narrow price action? And that's the way we describe it. So it's very much in terms of analogies to do with C and C states, and understanding that. And from that, you then can apply the tactical approaches. And again, it's understanding, first of all, yourself, the psychology of you as a person, what is going to suit you the best. If you're someone who has boundless depths of patience, then you might consider something like a breakout trading, where you're quite happy to sit through congestion phases, and they may be a long time on a 1-minute chart, they may be a long time on a daily chart. Anna showed you the congestion there. At some point, that market will break. It has to, because no currency pair or no market can stay congested forever. At some point, it has to break and move away from that congestion phase. And again, as we explained on the program, these are the most important regions, because when you look at any chart, the breakdown between the trend area and the congestion area very roughly breaks down to something like 70-30, 75%, 25%. In other words, the trending bits are much shorter than the congestion phases. So in a way, those are the areas you need to look at, because they happen more frequently on charts. They're also more important purely because from congestion phases, trends develop. Therefore, if you're going to be a breakaway trader, it's an ideal tactic. You wait for the congestion to build. You then start to look at your levels above and below in terms of support and resistance. And then you couple that with volume price analysis to give you the heads up as to whether a move away from a congestion phase is a genuine move or whether it's fake. And that's why breakaway trading gets such a bad press, because traders don't use volume to confirm whether it's genuine or not. And it's such a simple, powerful way of doing it. So you've got that aspect to it. So you can look at congestion phase as breakaway. If you're looking at it more, you prefer trend trading, then you've got to wait for those trends to develop, and you've got to understand the chart structure. Am I looking at a trend with volatility? Am I looking at a trend with momentum? You know, what am I looking at here? And what are the indicators and tactics going to take to that particular approach? You might prefer reversals. One of the things we talk about a lot, if I go back onto the CSI and see where we are, pick up some examples there. Just go back onto, here we are on 5 minutes. Let's go up onto a slower time frame. This is 10 minutes. Just move that out of the way. There we go, up onto 10. If you're looking at this as a reversal trader or a trend trader, if you're looking at this as a trend trader right now, then you might be looking at something like the euro here is rising very strongly on 10. We've got the dollar falling strongly on 10 minute along with the yen. So anything to do with the euro dollar or euro yen, there's going to be a strong trend there because you've got strong buying in the euro and you've got equally strong selling in the dollar and the Japanese yen. Don't even need to look at a chart to figure that one out. It's the power of the indicator at the starting point. This is on 10 minutes, so it will obviously clearly be different on much lower time frames, but that's what you're looking at in terms of these faster time horizons. In terms of looking at it from the perspective of a reversal opportunity, you've got the British pound up here, which is now strongly overbought. You've got the New Zealand dollar and the Aussie dollar, which are equally strongly oversold. So in terms of reversal, you might think, actually, do you know what? I'm looking at this from a reversal perspective. I'm looking at selling the pound and buying the Aussie or buying the New Zealand dollar, which is fine. The downside of that is clearly the trend has not started there. You are looking at it as a potential. You're not looking at it as something here which is already developing very strongly on euro dollar and euro yen. You're looking at this as a potential opportunity. And in looking at something as a potential opportunity, there is higher risk, and that comes at a price. And the price you pay for that is you have to set your stop loss much wider than you would do if you're trading a trend which is already underway. The analogy I've used many times before is of a train leaving a station. The reversal opportunity, you are basically, the train is in the station and you're sitting on the train and you're waiting for it to depart, but you don't know when it's going to depart. Now in trading terms, that means you've got to put a wider stop loss. Once the train's left the station in terms of the trend underway, you're jumping on board a moving train and you're going to set your stop loss that much tighter because the trend is already underway. And from that, you will then have an understanding of not only trend and momentum, but also the chart structure, whether you're jumping into a trend that's trend with momentum, trend with volatility, or whatever it may be. Anna's hopping up and down. I'm just going to pass back. Hold on a minute. I'm just going to switch myself off for a moment. Sorry, I always have the chat box closed off when I'm in full flow. Apologies for that. Anna's just highlighted the fact that Nick's put up a nice comment. Right, let me just read Nick's comment, and I think Anna's got, I think there's a question to answer as well, so let me just read Nick's comment. Yeah, hold on a minute.
David was talking about reversal trading, and in fact, this is something to consider as well. And it comes down to what type of trader you are. Reversal trader if you are looking for reversals, you also have to, as David said, the pros and cons of the advantages and disadvantages of reversal trades. But if you want to categorize yourself as what type of, are you a more conservative trader or an aggressive trader? I would say that as a reversal trader, because you have to take the decision perhaps to go in a little bit earlier, I would say and in fact it's something that a fellow trader in India highlighted, Vijay highlighted, is he would consider such a trader to be a more aggressive trader. And that comes down to your personality, and as David said earlier, you really have to understand yourself and your personality and what you don't want to come into this business and it keeps you up at night and it gives you sleepless nights and you feel uncomfortable. So if you are perhaps a more cautious trader and you don't like to get in early, you know, there are other tactics that you can employ. One of those tactics is perhaps looking at breakaways. And I know breakaways get a terrible press, they say, because there's so many fake outs. But honestly, if you understand, you know, if you use the principles of VPA and you have an indicator, and I'm going to make a push for the indicator, which is the volume point of control. Someone in the room, Donna, said, what is the yellow hatched line? That is the volume point of control. It is the point on the chart where we have price agreement. We have, in market profile terms, it's like almost fair value. There is no divergence. There is no desire to move this price strongly in one direction or another. It requires a certain amount of patience. And yes, you are going to, you know, perhaps it will break out and it will, you know, it will be a fake. But if you look at the volume and you look at the other indicators, you will be able to keep that down to a minimum. But the most important part of breakaway trading is because you have this very strong region on a chart where you have these consolidation phases. Consolidation phases may be there because it's a pair that's not traded very much, say, in the Asia session, so that traders are just, you know, happy to leave it alone for that time, for a period of time, or it's waiting for a piece of fundamental news. Just look at the price action, the chart structure before NFP. Look at the euro dollar. It's not trending, it's not moving, it's in consolidation because it's waiting for an important piece of news. But the important thing is, certainly with the VPOC indicator, is it tells you exactly where your stop loss needs to be, and it's quite tight. You can actually keep it quite tight, much tighter than if you were looking at a reversal opportunity where, you know, you have to give the potential move some space to breathe, as it were. So the VPOC, as I said, we developed it. We called it the volume point of control. It also looks at support and resistance. It's a volume-based support and resistance because we're looking at transacted volume. And also time, the amount of time that an instrument or a pair stays in consolidation. And bringing Wyckoff into it, the longer a market stays in this phase of price action, this condition of price action, i.e. moving sideways, as I said, David has said, it doesn't just move sideways, it could be volatile, as we looked at the pound Aussie, or it could be non-volatile. The longer it stays like that, when the breakout happens, when the breakaway happens, it's Wyckoff's second law of cause and effect. The effect is likely to be stronger, and in fact, we've had a perfect example on the on cable.
Thanks, darling. And just to pick, I'll answer. There was another question as well, low down. I'll just go back to Nick's point, which is a terrific point, Nick. Thank you for making that. The two things. First of all, a lot of traders, and I know we have a lot of students on the program who do take this approach and pay very close attention to the closing price action from the previous day and whether that area of price is taken out the following day. It's one of the areas I have to say that perhaps we should look at as just a very simple indicator, because it's a bit of a pain having to draw lines all the time. We do it from time to time, so we might look at that. But certainly, it's an important point that you look at the close of the previous day or the session, and just see, particularly on the daily, and just see where the price action opens and whether that particular high or low is being taken out. It just gives you another view, if you will, on where the price action is heading and important key areas from the previous day. The other point, as Nick says, is when you're looking at this, first of all, multiple time frames. He's got the 1 minute, I had the 15-second up. And if you're looking at the volatility, what you're looking for is confirmation of reversal. You're back to looking at straightforward VPA, if you like. You're looking for weakness, you're looking for high volume, anomalies, you're looking for low volume, and you're looking for the opportunity to, you'll hear a lot about trade the fade, where you see a market move very strongly and then reverse. We often refer to it as the souffle effect. You see it a great deal in terms of pounds, certainly driven by politics. You'll see it in other markets as well, basically where the market reacts spontaneously to an item of fundamental news, or a political statement, or someone has said something. the market snaps. We've seen it God knows how many times on the pound. Someone says something in Europe or someone says something in UK Parliament, the pound reacts instantly, very sharp move, and then once the reality of what was said is absorbed into the market, then it tends to reverse like a souffle. So it goes up relatively quickly, and then it deflates fairly slowly. And you see that all the time. It is an opportunity to reverse trade, but you've got to follow a VPA to understand what it is you're looking at in terms of the volume price that follows thereafter. So it's another aspect, if you like, to reversal trading, where you are looking at the opportunity once something has arrived to then take a reverse position, if that is your cup of tea, which really follows on to to Tony's question, which is more profitable. Well, it's up to you to choose. You've got to find out what works for you, what works for me, what works for Anna, what works for other people in the room may or may not work for you. It depends on your psychology. It depends how much time you've got available for your trading. It depends what time frames you're using. There is absolutely nothing in this business and in this market that says if you adopt this approach, it's going to be more profitable for you. It just doesn't work like that. You have to find out what works for you, not for anybody else. You have to develop it accordingly. You might find out what works for you is trend trading on 3 pairs. That's fine. Someone else will be doing trend trading on 28 pairs. That's fine. Someone else will be doing reversal trading on 2 pairs. That's what works for them. Somebody else will only take one tactic to market. They will only take breakaway trading. All they're interested in is congestion trading. That's all they look for, but they do it on the 28 pairs. Another trader might decide that they're only going to do it on 2 pairs, but that's their tactical approach. So you can either take a tactic to multiple markets, or you can take multiple tactics to all the markets or to a few markets. It's your choice. You have to decide. And that's why the psychology of trading is so important, because if you don't understand yourself and your attitude to risk, how comfortable you are with taking risk, then that's what ultimately will help you to understand what is going to suit you best. You know, it's about discretionary trading. Do you have discretionary trading? What sort of rule sets do you have with your discretionary trading? Are you more suited as a systematic trader? That's what you have to figure out and find out for yourself. I can't tell you that, and there's no rule book that says one or the other is more profitable. And it depends what state the chart's in. It's all about understanding chart structure and et cetera, et cetera. So it's not. I wish it was as simple as that. Unfortunately, it's not. Can't give you a straight answer to that one because there isn't one, I'm afraid. Sorry about that. Just pop that down. Let's see where we're going. Let's just head over quickly. What's the time? Just very quickly take a look at the currency indices, just see what's going on here. These are the indices themselves. So what we're looking at is basically the 4 primary currencies: yen, dollar, and we've got the euro and the British pound. And what we're seeing is pretty much what's reflected on the CSI. We've got very strong selling in the yen. So if I headed over to indices, we'd probably see those ticking up on Globex, which would be nice. We've got the dollar selling off quite strongly. We've got some decent euro buying here, and we've got strong pound selling. That was the knee-jerk reaction higher. Now we're starting to see it reverse lower pretty strongly as well. So from doing nothing, and I suppose in a way, what this highlights is what I was saying earlier on about congestion, and then you get these strong moves. It's a question of being patient, waiting, and just finding out what works for you. There we go. I'm going to pass back to Anna.
And I've just moved over to the Aussie yen. As David said, the indices moving higher, the yen's moving lower. I've hit the S&P. I had a quick look at investing.com. Here we are. What's Globex up? Well, the S&P is up 5, which is it's all climbing nicely, as we said, all reflected in the yen selling. And going back to now this is the hourly chart of the Aussie yen. This move higher, it's actually off the VPOC. The VPOC wasn't here when I looked at it yesterday. We can see here it says it's climbed the most in the last hour than it has in the last couple of days. But what I wanted to show you, this is the hourly. This is the Renko. Now this Renko move here you can't even match it to the 3-minute chart, which is what I usually use it with. It actually matched what was happening on the hourly chart. This is the 74 level, where the price actually started to move higher, but it's really, as I said, and you think, oh well, that looks like a nice move, but that was 74.02, and what do we have here? 74. Well, we didn't get to 51. I looked at it when it was here, it was only 30-40 pips. It actually put another 12 in overnight. Then we've had a slight pullback there, but this is the hourly chart. Something like another pair, which is more volatile in the sense that it has a wider range. It moves more in the sessions and over a period of time. Something like the pound yen, even some of the cross pairs like the euro Aussie, the pound Aussie. This is what you have to understand. It's the next phase on. We can see we've got a nice trend moving higher. This is the hourly chart, but look how much it has actually moved. And in fact, in some ways, staying in the longer you stay in a position, the riskier it becomes, because there's always the threat that it's going to be overturned by some unexpected event. There's always fundamental news coming along. Keeping trades open over medium term and longer term, certainly in the forex market, you're going to be hit with the next cycle. I mean, it's a month since the last ECB. Now we have another ECB. I've actually got some euro trades on, but mine are, this is in another account. They are very, very, very long term. They're much more sort of fundamental based trades. Yes, I use the chart, but I have to take the swings, if you like, that the price action is going to be affected by the price action is going to be affected when we have an event such as NFP, such as the ECB. The good news is in forex is these events happen on a regular, and it's very cyclical in that sense. So if you like, this is another thing you have to do. You almost have to sort of pick the period of time where you would like to, when are you going to trade if you want to avoid these particular sort of big ticket events, as it were. So that's what I wanted to say there. The difference in the moves that we can see in different pairs, different market conditions, what drives these pairs, the decisions you have to make as a trader. We're going to be moving on. We're going to carry on with this sort of narrative, and then we're also going to have a look at, well, what kind of indicators do you actually need to help you in determining, what is the chart structure that you're looking at any given time. We touched on the volume point of control in response to an answer to a question from someone in the room. I'm going to talk about that in more detail. Support and resistance comes in. We saw support and resistance, how it affected the pound Aussie move that we saw. We looked at that resistance. It coincided with the London Open, volatility, all these factors coming together, to help you make the right trading decision. Anything else you want to say, David? No, that's it. We are back later on, as I said, for the second webinar. If you would like to come along, we'll be looking at certainly the indices, the US markets, maybe some commodities as well. I want time to have a look at gold again. So if some of you I know will be coming along. If you're not coming along to that, we are back next Thursday. So whatever happens, have a great trading day. Enjoy the rest of the trading week. And as I said, we'll either see you, in inverted commas, this afternoon, or we will see you next week. Take care.